Imagine waking up in the morning, enjoying your coffee calmly, and realizing that even while you were sleeping, money kept flowing into your account. That's passive income. It's the ability to create sources of earnings that don't depend on your constant effort, allowing you to live with more freedom and peace of mind. Robert Kiyosaki, author of the best-selling Rich Dad, Poor Dad, teaches that this is the safest path to achieving financial independence and breaking the cycle of working only to pay bills. He himself built his fortune by creating and investing in assets that generate income even when he's not directly involved. In this video, we'll go through the 6 most powerful assets that Kiyosaki considers essential for anyone who wants to get rich and have total control over their time. Get ready. This journey might change the way you see money forever. Passive income is, simply put, money that comes in even when you're not actively working to earn it. Unlike a salary, which depends on hours worked and daily effort, it keeps flowing while you rest, travel, or dedicate your time to other activities. It's like planting a tree. At first, you invest time, energy, and resources to help it grow. Later, it starts bearing fruit year after year without needing to be replanted. Robert Kiyosaki emphasizes that passive income is the pillar of true financial freedom because it frees you from the obligation to trade time for money. With it, you gain the ability to choose how to spend your days. Whether it's spending more time with family, traveling, or starting new projects, it's not just about earning more, but about earning smarter, creating a system where money works for you. This shift in mindset is what separates those who are always chasing their next paycheck from those who build lasting wealth. For Robert Kiyosaki, real estate is one of the most solid pillars of building passive income. He's not just talking about buying a house and waiting for it to appreciate. He means creating constant cash flow through it. Imagine owning a commercial building or a small store that pays you rent every month. That payment repeats month after month like clockwork, whether you're working or not. The detail is that Kiyosaki shows you don't need a fortune to get into this game. Many investors use what he calls other people's money, that is, bank financing or strategic loans, to acquire the property. The logic is simple. The rent received covers the loan payments and still leaves a profit in your pocket. That way, you create an asset that pays for itself and, in the end, is 100% yours. For those who don't want to deal with maintenance, renovations, or tenants, there's a smart alternative: real estate investment trusts, REITs. They allow you to invest in large developments, such as shopping malls, office buildings, or logistics warehouses, without actually buying them. You purchase shares and receive your portion of the profits, usually in the form of monthly dividends. This type of asset not only generates steady income, but also protects against inflation, since rental values tend to keep up with the cost of living. It's like having a legal, safe money printing machine, as long as you know how to choose the right properties or funds. Kiyosaki says that investing in dividend-paying stocks is like having small companies working for you 24/7. Here's how it works. When you buy shares of a solid, profitable company, it may decide to share part of its profits with its shareholders. This payment, called a dividend, goes into your account without you having to sell your shares. That's pure passive income. He shares a personal case where he achieved more than 20% annual return just from dividends. But to reach that level, you need knowledge, analyzing companies, understanding their financial statements, payment history, and future prospects. It's like planting in fertile soil. You want to be sure you're investing in something healthy and capable of bearing fruit for a long time. For those who don't want or don't have time to study individual stocks, Kiyosaki suggests ETFs, funds that group several dividend-paying companies into a single investment. They tend to have slightly lower returns, but offer more security through diversification. The secret here is not to try to get rich overnight, but to build a portfolio that grows and pays more and more over the years. With discipline and reinvesting the dividends you receive, you can reach a point where they cover your monthly expenses, and that's when financial freedom becomes real. For Kiyosaki, creating or investing in businesses is one of the most powerful ways to generate passive income because the growth potential is virtually unlimited. But he's not talking about opening a business that depends 100% on your daily presence, where if you stop working, revenue plummets. He means scalable businesses that can run on their own, with well-structured systems and teams. A classic example is digital products, like ebooks, online courses or apps. You create them once, put them up for sale, and can receive sales at any time, even while you sleep. Another example is franchises or well-organized physical businesses where you delegate management to others. And it's not just about starting from scratch. If you don't want to create your own business, you can invest in existing ones. This can be done as an investor partner, contributing capital and receiving a share of the profits, or even by buying equity in high-potential startups. What Kiyosaki reinforces is that well-structured businesses not only generate passive income, but also create assets that appreciate over time. So, in addition to the money coming in every month, you're building an asset you can sell in the future for a much higher value. It's like planting a tree that not only bears fruit constantly, but also becomes more valuable as it grows. Kiyosaki explains that this is one of the most interesting assets because it turns creativity and knowledge into money for many years. When you create something unique, a book, a song, software, or an invention, and register the intellectual property, you secure the exclusive right to market or license that creation. The result? Royalties, recurring payments that keep coming in without you having to produce everything again. Think of an author who wrote a bestseller 10 years ago and still receives checks every month from sales. Or an inventor who developed a technology and licensed it to companies, receiving a percentage from each unit sold. It's like planting a single seed that keeps producing fruit for decades. The big advantage of this asset is that after the initial work of creating and registering it, it can continue generating income with almost no additional cost. And in some cases, revenue even increases over time, especially if the work or invention becomes more well-known. Kiyosaki points out that while this path requires creative effort and sometimes technical knowledge, it's accessible to anyone willing to develop something of value. And remember, even if you don't create it yourself, you can invest by buying existing copyrights or patents, becoming the legal owner of a continuous passive income stream. Kiyosaki teaches that fixed income securities are like lending money to the government or companies. In exchange, you receive regular interest payments. It's a more predictable type of passive income because you already know from the start how much you'll receive and on what dates. For example, if you buy a 10-year government bond, every 6 months or every year, you receive interest payments. And at the end of the term, you get back your initial investment. Government bonds are generally considered the safest as the risk of default is very low. Corporate bonds issued by companies usually pay higher interest but come with greater risk, depending on the company's financial health. Here, the key is to carefully assess the issuer and diversify. An advantage of this type of asset is stability. Even during crises, many bonds keep paying, which provides a sense of security. However, Kiyosaki warns about two important points: inflation, which can erode the purchasing power of interest received, and the risk of the issuer not honoring payment. For him, fixed income securities can be an excellent complement to the portfolio of someone seeking financial freedom because they balance more volatile investments like stocks and real estate. It's like having a reliable friend who always delivers on time, even if the amount isn't the highest. Kiyosaki describes annuities as a type of contract with an insurance company that guarantees regular payments for a set period or for life. It's like creating a private pension where you invest an initial amount and, in return, receive a steady income, often used to supplement retirement and maintain financial security without relying solely on public benefits. There are three main types. Immediate, start paying right after the initial investment. Deferred, start paying in the future, allowing the invested amount to grow before generating income. Variable, payments change according to the performance of the investments made by the insurer. The big advantage is predictability. You know you'll have a fixed amount coming in, which helps with planning and brings peace of mind. But Kiyosaki warns about some risks. Annuities can have high administrative fees, penalties for early withdrawal, and in some cases may not keep up with inflation, reducing purchasing power over time. That's why he recommends using them strategically as part of a diversified passive income portfolio. This way, you can combine security and stability without giving up assets with greater growth potential. It's like having a safety net that ensures that, no matter what happens, you'll always have cash flow to sustain your lifestyle. Many people delay starting their journey toward financial freedom because they think they need a lot of money to invest. Kiyosaki is clear. It's not the size of the capital that matters, but the decision to start. Even a modest investment made consistently can grow surprisingly over time thanks to compound interest and reinvested profits. Think of a bricklayer building a house. He starts by laying the first brick, then another and another, until the house is complete. In the investment world, each brick is a contribution, a new asset you acquire. At first, progress seems slow. But there comes a point where growth accelerates and you realize you've already built a solid foundation. The secret is not to wait for the perfect moment. Start now, even if it's with a small amount. The important thing is to build the habit of investing and let time and discipline do the heavy lifting. Kiyosaki teaches that the greatest asset you can have isn't in the bank, it's in your mind. Knowledge is what separates those who multiply money from those who lose it. When you understand how money works, how to identify good opportunities, and how to assess risks, you stop depending on luck or hot tips and start making safe, strategic decisions. It's like driving a car. In the beginning, you may feel insecure, but with practice and the right guidance, driving becomes second nature. With finances, it's the same. The more you learn, the more confident you become in accelerating toward your goals. And here's an important point. The knowledge you acquire today can generate income for a lifetime. Every book you read, every course you take, and every mentor you listen to is like adding tools to your toolbox. At the right moment, those tools will allow you to build something valuable and lasting. Kiyosaki reminds us that it's not the big leap that changes everything, but the small steps repeated day after day. Consistency is what turns ordinary investments into extraordinary wealth. It's like water that, by falling continuously on stone, can shape it over time. Many people get discouraged because they want quick results. But true wealth is built solidly, with consistent financial habits, investing every month, reinvesting profits, controlling expenses, and always seeking new sources of income. These habits combined create a snowball effect. At first, it's small and slow, but as it rolls, it gains weight and speed until it becomes unstoppable. The power of consistency lies in the fact that it works even on bad days. You may have a difficult month, but if you keep the habit of investing, the process continues to move forward. And when you look back, you realize that daily commitment built something far greater than you imagined. Kiyosaki always emphasizes that the wealthy think in decades, not days. While many focus only on the next paycheck or monthly bill, those who build wealth are planning where they want to be in 5, 10, or 20 years. This mindset completely changes how you handle money. Thinking long-term means choosing investments that may not bring immediate returns, but have the potential to grow and generate income for many years. It's like planting an orchard. In the first years, You may not harvest anything, but when the trees mature, they produce fruit every year without needing to be replanted. This vision also protects you from impulsive decisions. When the market fluctuates, short-term thinkers panic and sell. Those with a long-term vision see those drops as opportunities to buy at lower prices. Over time, this patience is rewarded exponentially. Kiyosaki teaches that you should never put all your eggs in one basket. Having only one type of investment is risky because if something goes wrong, your entire wealth could be compromised. Diversification is like building a team. Each player has a different role, but they all work together to win. By combining different assets, such as real estate, stocks, businesses, bonds, and royalties, you create a safety net. When one sector is down, another may be performing well, balancing your portfolio. This strategy not only reduces risk, but also opens more doors for growth opportunities. Smart diversification doesn't mean investing in anything that comes along, but carefully choosing assets that complement each other and align with your long-term financial goals. For Kiyosaki, every crisis hides an opportunity to grow. Most people see tough times as periods to survive, but prepared investors know that it's in these moments the best opportunities arise. When everyone is fearful, valuable assets can be bought at prices far below normal. He reminds us that the difference between failure and success is in mindset. Those who see obstacles as barriers remain stuck. Those who see them as steps climb to the next level. Developing this vision requires calm, financial education, and the courage to act when most retreat. Crises come and go, but those who learn to take advantage of them build wealth when others are losing it. Kiyosaki says, relying on a single source of income is like trying to balance a table on just one leg. Any instability can knock it over. Creating multiple sources ensures that if one stops working, the others will continue sustaining your lifestyle. This can include your own business, stock investments, rental properties, royalties, consulting, and more. Each new income stream is like adding another pillar of support for your financial security. Over time, this network of sources becomes so strong that no matter what happens in the market or economy, you will always have a steady flow of money coming in. That's true independence, not living at the mercy of a single paycheck, but having full control over how and where your money comes from. Kiyosaki explains that many people make the mistake of spending all the profit their investments or businesses generate. Real growth happens when you reinvest that money into new assets, expanding your portfolio and accelerating the effect of compound interest. It's like planting seeds. If you eat all the fruit you harvest, you'll never have more trees. But if you save some of the seeds and plant them, in no time, you'll have an entire orchard. The more you reinvest, the faster you build a self-sustaining passive income system. Kiyosaki reminds us that it's not enough to create wealth. You must protect it. Many build fortunes and lose them due to lack of planning, poor investments, or bad management. He advocates for strategies such as diversification, proper insurance, asset protection, and continuous education to avoid unnecessary losses. Protecting wealth is like guarding a fortress. You build walls, gates, and guards not out of fear, but because you know what's inside is too valuable to leave unprotected. The more secure your assets, the more peace of mind you have, and the bolder you can be in your growth decisions. Kiyosaki teaches that time is the most valuable resource there is, and how you use it determines your financial future. Instead of spending hours only on immediate tasks, he suggests investing time in creating something that will keep generating returns. This could be writing a book, developing a product, creating an online course, or building an automated sales system. Each hour spent building an asset is like placing bricks in a structure that will stand for years to come. That way you stop trading time for money and start turning time into lasting wealth. Many people think creativity is an exclusive gift for artists, musicians, or writers. Kiyosaki debunks that idea. For him, creativity is the ability to find new solutions to old problems. And this is extremely valuable in business and investing. Think of entrepreneurs who created simple yet brilliant products like adhesive tape, the paperclip, or apps that now seem indispensable. None of them reinvented the wheel, but all solved real problems in creative ways. This ability to spot a need and create something to meet it can generate passive income for many years. The good news is that creativity can be trained. Reading more, observing trends, asking different questions, and connecting with people from different fields stimulates ideas. And when creativity meets action, it stops being just imagination and becomes valuable assets that work for you. Kiyosaki learned early that your value in the marketplace is proportional to the value of your network. Having good connections doesn't just mean knowing a lot of people, but building relationships with those who can open doors, point to opportunities, and offer strategic advice. If you want to invest in real estate, knowing brokers, specialized lawyers, and experienced investors shortens the path. If you want to grow in the stock market, being close to analysts and fund managers can help you anticipate important moves. And if you plan to start a business, surrounding yourself with the right suppliers, clients, and partners can be the difference between success and failure. A strong network not only multiplies opportunities, but also reduces risks because you have access to information and experience you wouldn't have on your own. And building this network is simple. Offer help, share value, and maintain genuine relationships. When you build a good reputation, doors open before you even knock. One of the most common mistakes Kiyosaki sees in beginner investors is making decisions without understanding the economic climate. Just as a farmer must observe the seasons before planting, a smart investor needs to analyze factors such as inflation, interest rates, economic policies, and technological advances before acting. When you understand these movements, you can position yourself ahead. For example, if interest rates are dropping, real estate and stocks tend to appreciate, creating good buying opportunities. If there's a risk of high inflation, assets that protect purchasing power, like gold or real estate, become more important. Reading the economic landscape doesn't require being an economist, but developing the habit of following reliable news, studying trends, and understanding how they affect your investments. Those who learn to do this avoid traps and seize moments that most people miss. We live in an era where everything changes quickly. Technologies emerge, markets shift, and consumer behavior changes overnight. Kiyosaki reminds us that in this scenario, adaptability is one of the greatest assets you can have. Companies that once seemed unbeatable have disappeared because they didn't adapt. Just think of major brands that ignored the rise of the internet and lost their place. On the other hand, entrepreneurs who changed course, launched new products, or entered emerging markets not only survived but grew exponentially. To adapt quickly, you need to be alert to trends, listen to the market, and not be afraid to change strategy. Those who cling to a single business model or one investment risk being left behind. Those who keep an open mind and are willing to learn are always ready to turn change into opportunity. Kiyosaki always emphasizes that true financial freedom comes when you build systems that generate income without requiring your constant presence. A system can be an automated business, a well-structured investment, or even a set of processes that keep cash flow going even if you don't lift a finger. Think of a franchise. The owner sets the model, trains the team, establishes standards, and leaves the business running with managers. Or imagine an online store with outsourced logistics, where the entire process, from purchase to delivery, works automatically. In this setup, you're not the worker, but the architect who designed the structure to run on its own. The advantage of creating systems is that they free up the most valuable resource there is: time. When you're not tied to operational tasks, you can focus on expanding, creating new assets, and diversifying your income even more. That's how one asset turns into many, and that's how financial growth accelerates exponentially. Kiyosaki always repeats that one of the most powerful shortcuts to financial freedom is learning from people who have already achieved what you want. This doesn't just mean admiring success stories, but seeking to understand the decisions, strategies, and even mistakes those mentors made along the way. Having a mentor is like receiving a map to an unfamiliar territory. You still have to walk it, but you avoid dangerous paths, save time, and discover shortcuts you might never have found alone. It could be an experienced investor, a successful entrepreneur, or even the author of a transformative book. The important thing is that it's someone who's already walked the road. Kiyosaki himself learned much of his philosophy from the rich dad, who showed him that wealth isn't built solely through hard work, but through intelligence, vision, and the courage to take action. He teaches that by surrounding yourself with people like this, you absorb habits, mindsets, and ways of spotting opportunities that completely change the game. The lesson here is clear. Walking alone is possible, but walking alongside those who already know the path makes the journey faster, safer, and often more profitable. And before we wrap up, I want to know, which of these principles will you apply first to transform your financial life? Leave your answer in the comments, share this video with someone who needs to hear this message, and subscribe to the channel to keep receiving content that will open your mind and speed up your journey toward financial independence.